people need to really kind of abstract out how to think of what the move in gold is actually signifying. Because once you get it, it's red alert. If you bounce the budget, it would result in a GDP contraction worse than 2008. You have the reverse repo empty, bank reserves are declining. The largest marginal buyer of our debt is a bunch of 100-to-1 levered hedge funds in this basis trade. The Cayman Islands actually hold $1.8 trillion of our debt, undercount by $1.4 trillion.
Foreign governments now officially hold more gold in reserves than U.S. Treasuries.
China held about $784 billion just in 5 months from February to now. That's down to $730 billion. That's significant. What you could get is a revaluation of some of these currency crosses. I don't understand how anyone could argue that China's not the one with the leverage. I mean, we lost effectively a proxy war to a country with 1/12 of our GDP. You end up talking about like a $5 trillion deficit in just a normal recession. They're trying to thread a needle here. I don't know if it's going to work. The only thing that I have high conviction in is Bitcoin.
Robert, welcome back to the show, sir.
Good to be back.
Good to have you back. I've been binging your YouTube channel the last 2 weeks. I was telling you, before that I was checking in once a week, but I think with all the madness going on in markets right now, you've been covering everything going on with great detail. It's astonishing the amount of detail that you can go into and the amount of data that you're able to surface. I reached out last week. I said, hey, we'd love to catch up on the show. Last time you were on, we talked about silent depression and sort of the more secular headwinds, if you will, societally, in terms of the effect that the economy is having on individuals and society at large in aggregate. And I think we can definitely touch on that later, because I think things are certainly accelerating as AI becomes more prominent and people begin to worry about what the job market is going to look like moving forward. But I think, just to stay timely and topical, you've been covering a Fed report that was dropped, I believe, over the weekend that highlights the dynamics of the Treasury market are not what they were being reported. And it all stems from activity going on in the Cayman Islands, particularly around the basis trade. So what did the Fed just let the markets know? Yeah,
so apparently we had suspected, according to the TIC data, which is released by the Treasury Department, it's basically the official data on who holds U.S. government debt and general cross-border capital flows. That TIC data had reported that the holders of our debt were Japan at about 1.1 trillion, UK at about 900 billion, China at about 700 billion, and that has been coming down pretty notably. And then the Cayman Islands as our fourth largest holder at about 400 billion. But because of this popular hedge fund trade known as the basis trade, the Cayman Islands, obviously a hot spot for hedge funds domiciled in the Cayman Islands. This has nothing to do with like the Cayman government. When we're talking about the Cayman Islands, we're talking really about the fact that there's so many hedge funds based there, domiciled there. The Cayman Islands actually hold $1.8 trillion of our debt. And so that makes them by far the largest holder of U.S. government debt.
And before it was being reported that they held what, around 400?
400. Yeah, 400.
And
so undercount by $1.4 trillion.
So what I'm trying to understand is why wasn't this reported correctly before the Fed released this report? And why did the Fed decide to let everybody know, oh, well, actually, here's what's going on?
Yeah, that second question is one kind of the first one that popped into my head after I realized the implication of this. My first question is, okay, well, why now? So it has to do with like how they calculate the repo, because this basis trade is financed in the repo market, which makes SOFR and what's going on there, I think, pretty important. But it has to do with just the methodology with which they use to measure various cross-border capital flows.
Yeah. And so for anybody who's listening who may need a refresher on the basis trade, what are hedge funds doing when they engage in this?
Yeah. So the basis trade is Treasury futures. Let's just use a 10-year Treasury. There's the cash 10-year Treasury, which most people are familiar with. But then there is a futures contract that represents a 10-year Treasury. That 10-year Treasury futures contract is obviously a contract for future delivery. But there is this optionality that the seller has when you sell a 10-year Treasury futures contract. There's optionality there where you get to actually deliver. You don't have to deliver a 10-year Treasury at the end. You can deliver 6.5-year maturity, 7-year. There's a range. And so the seller gets to choose the cheapest option for them. Maybe at the time, it's a 10 basis point difference between the 7 and the 10. So they deliver the 7, even though it's a 10-year Treasury contract. And that kind of optionality or uncertainty premium is baked into the futures contract. So it's very small. It's only about 10 basis points or 0.1%. And so that trades at a premium, the future. And so what they do is they short the futures contract and then they long the underlying US cash Treasury. And the difference as expiration nears, Treasury futures, kind of expire every 3 months. As you near to expiration, that difference, as the arbitrage kind of gets worked out, goes to zero. And so you're basically just pocketing the spread between the futures contract and the 10-year the actual 10-year Treasury. And so it's delta neutral, because if bond yields go up, well, you're covered because you're short the 10-year futures contract. Bond yields go down, you're okay because you're long the cash 10-year Treasury. So it's delta neutral, meaning and also it's using probably, at least what the market considers to be pristine collateral. We have different opinion on that, but yeah, so the fact that it is using U.S. Treasuries as the collateral for financing in the repo market makes it less risky. And of course, you're delta neutral. So it doesn't matter if bond yields go up or go down. You're just trying to pocket the tiny little difference between that futures contract and the actual 10-year Treasury as it approaches expiration. And you lever it up. So if it's only 0.1%, that's not worth anything. That's not worth anyone's time. So what they do is they lever it up 50 to 1 to as high as 100 to 1. And that might sound crazy, but this is well documented on Google. And this has been an issue for years. This has been a risk that the Fed has known about. This has been a risk the SEC has been aware of, the CFTC, various organizations. You can find all sorts of academic papers talking about the risk that this basis trade has. It's blown up. 2020, it blew up. It also sort of started to blow up in April during the Liberation Day. So it's a known risk. And the leverage is well documented to be pretty insane.
Yeah, and you cited it in one of your videos from the last couple of days, but the Brookings Institute came out in June and wrote a paper, I believe, in reaction to the April blowout of this basis trade. I think a lot of people have been focused on the yen carry trade as well. And it just seems like wherever you look, there's a ton of hidden leverage in the system. And again, going back to the original question, why did the Fed feel compelled to release this data, particularly after we had the SOFR spasm last week? SOFR spread to Fed fund rate spiked to 0.19%, which is pretty high, highest point since 2020, I believe.
Yeah, it does make you wonder the timing of it, and of course, Jerome Powell came out and mentioned basically the end of QT, funding stresses in the repo market. This was, I think, Wednesday. And then, we got data on SOFR for Wednesday and Thursday, which was quite elevated. For Wednesday and Thursday, SOFR, the secured overnight funding rate, was actually above the discount window rate, which is the Fed's attempt at setting a ceiling in the price of money. They actually have a range. They don't set one interest rate. They have this corridor or this range that they use to set interest rates, and the lower bound being the reverse repo award rate. That is the Fed's attempt at basically saying no matter how overabundant dollars get, we will always buy them from you at 4%. And then the discount window rate is the upper bound, and that is the Fed trying to say no matter how scarce dollars get, we will always sell them to you at 4.25. So by doing that, hopefully thinking of it that way makes it a little bit easier for people to understand. But by maintaining those two different interest rates, they're able to try to keep SOFR, which is the actual funding rate determined by supply and demand of dollars within the repo market. They try to keep SOFR within that range by having those two tools.
Yeah. And typically when you see spasms in these markets, it means that a liquidity crunch is on the horizon, like you said. Jerome Powell implicitly seems to believe that may be the case with his comments around the end of quantitative tightening. There was regional banks last week had a pretty tough middle of the week with many down more than 10%, and you saw the sort of reemergence of a theme that reared its head a couple of months ago with the tricolor auto loan, subprime auto loan collapse. It seems like there's other similar lenders that are out there under a lot of stress, and you have banks as big as JP Morgan with exposure to them. I think JP Morgan had to write down $200 million in credit loss on one of these deals last week. And that's the question, like, is there a liquidity crunch?
Well, yeah, I mean, what SOFR, so the first video I did on liquidity and repo market and SOFR, and I think it was back in like July, because I think that was about the time when they announced they were going to rebuild the Treasury general account, or the TGA. This is the government's checking account, just like you would like a buffer in your checking account, the government does too. It was down to, I think, only 300 billion or so. So they wanted to build that back up. And basically, when that was announced, I started to kind of warn that there would be increase, that in and of itself would cause a shortage of liquidity, at least compared to what it was before. The reverse repo was dwindling down. And so, normally the reverse repo, it's not a primary method of managing liquidity. It's more one of those, I think of it as a shock absorber or a buffer. And so as that buffer was drawing down, meaning the amount of buffer for dollar liquidity was getting smaller, kind of all of it was lining up, and you were starting to see some elevation in SOFR spreads, SOFR minus reverse repo or Fed funds. You're starting to see that kind of back in June, even at the end of June. And it's normal to see at the end of the end of the month or end of the quarter or tax deadline, which we saw a couple weeks ago, I guess about a month ago. It's normal to see SOFR start to kind of blow out. But what has been happening recently, like over the past couple of days, is we've seen SOFR notably above, like I mentioned before, discount window rate, IORB, Fed funds, reverse repo award rate. And then you couple that with the credit issues and the fact that credit spreads have started to widen. They're still near kind of all-time tights, almost historically tight credit spreads. But so we're starting from a pretty stable or decent position. But the fact that credit spreads have started to widen, you couple that with what's going on with SOFR, then you start to kind of factor in this basis trade and an unwind of the basis trade threat, I guess you could call it. And it's all, it's like we found out, we know that SOFR, we know funding stress in the repo market from SOFR. We know the reverse repo is empty. The TGA rebuild is basically done. So shouldn't have any further negative impact on liquidity, but it certainly did. They removed $500 billion from the financial system. That's not nothing. But that is done. But you have the reverse repo empty, the TGA rebuild removed $500 billion. Bank reserves are declining. They're right around $3 trillion last I checked. And so, yeah, you kind of couple it all together and it's like, okay, so the largest marginal buyer of our debt, foreign at least, is a bunch of 100-to-1 levered hedge funds in this basis trade. It's extreme. That basis trade must be financed every night in the repo market. So you start to get, widening of SOFR spreads that could put funding stress on the basis trade, causing an unwind of the basis trade, which could cause and what an unwind of the basis trade looks like. Remember, you're long the cash treasury and you're short the future. So if you are forced to unwind that position, it puts upward pressure on the future and downward pressure on the bond. You're forced to do the exact opposite of how you got into the trade. So it involves selling of the bond, which means yield sharply up, and then buying of the future to close your short. And so we've seen this, before in 2020. You can look at TLT relative to ZB, which is the long bond futures contract. You can see this happen, for example, in March of 2020. It also started to happen again in April with Liberation Day. You get yields sharply higher. Not good for liquidity either.
No. And on top of this, last week we had the standing repo facility tapped for the first time since COVID, I believe. And it was tapped.
Not the first time, but what happened was, if you think of the reverse repo, which is that storage tank for kind of excess liquidity you can think of, you take the reverse repo and you subtract out how much standing repo is being used, that spread kind of gives you an idea. Are we in an abundant liquidity regime or a scarce liquidity regime? It's kind of how I think about it. So, previously we've been in an abundant liquidity regime where the reverse repo has been as high as $2.5 trillion. And that storage tank of kind of that shock absorber has been full of cash, of dollars. And what we had recently was standing repo's been hit. I think it was hit back in, I want to say August, might have been June. There have been a couple brief moments in the past year or so where it's been hit. But what we had recently was that standing repo, which again is the opposite of the reverse repo. The standing repo, or SRF, that is for when there's a shortage of liquidity and hedge funds need emergency dollars. That standing repo got tapped, and you take that spread, the difference between the reverse repo and the standing repo, that went negative for the first time, going all the way back to March of 2020.
Sup, freaks? This rip of TFTC was brought to you by our good friends at Bitkey. Bitkey makes Bitcoin easy to use and hard to lose. It is a hardware wallet that natively embeds into a 2 or 3 multi-sig. You have one key on the hardware wallet, one key on your mobile device, and Block stores a key in the cloud for you. This is an incredible hardware device for your friends and family, or maybe yourself, who have Bitcoin on exchanges and have for a long time, but haven't taken the step to self-custody because they're worried about the complications of setting up a private public key pair, securing that seed phrase, setting up a PIN, setting up a passphrase. Again, Bitkey makes it easy to use, hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a Bitkey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20.
Sup, freaks? This was brought to you by our good friends at Obscura. If you've been listening to the show long enough, you know we care deeply about privacy, particularly as you peruse the web. It is important to be using a VPN, and Obscura is our VPN of choice. That is because it is a VPN built by a Bitcoiner for Bitcoiners. It is the first VPN that can't log your activity and outsmarts internet censorship. Obscura VPN works even in the most restrictive Wi-Fi networks where other VPNs simply fail to connect. With server locations across America and the globe, Obscura keeps your internet access unrestricted wherever you are. I've been using it since it launched. I see no problems with speed. I can get on YouTube TV without any problems. It simply works. They can't log. You can pay in Bitcoin. Go to obscura.net. Use the code TFTC25 for 25% off an annual subscription. It's already a good deal, their annual deal. The TFTC25 code gets you 25% more off. Go check it out, obscura.net. Use the code TFTC25. Now, as you're explaining all this too, and you have the government shutdown in the backdrop of all this too, like, what is the Fed release of this Cayman data sort of like a signal, like, hey, politicians, we've got a pretty massive exposure to this carry trade by predominantly American hedge funds domiciled in the Cayman Islands. Like, it may be time to turn the government back on so that we can solve this crisis if it does emerge.
It could be a lot worse if it was a debt ceiling debacle like we had earlier. That I think would be significantly worse. That's probably coming. We go through those debt ceiling debacles all the time, it seems. It's like a constant thing in American politics. So whether it's a government shutdown or a debt ceiling debate, there's always that kind of embedded stress that it seems like it happens every year or so.
Yeah. Well, and then I just recorded with Luke Roman. Another sort of variable in the backdrop here is this, I don't know if it's an attack, or it seems like China, the BRICS countries, many others are noticing what's going on with the U.S. Treasury market, and not only the Treasury market itself, but the U.S. government, which is backing this market. And they're saying, I don't know if you're a good counterparty if we're going to be buying your debt. And so we've seen massive transition towards this gold settlement network, which is many people are surmising what's happened with China registering its gold on warrant at the Shanghai Gold Exchange. That chart became popular about a month or two ago, but I saw Jim Bianco updated it, and it seems like that's only increasing at a rapid pace. It's almost doubled in the last month, the amount of gold on warrant at the Shanghai Gold Exchange.
Yeah, it's vertical.
Yeah, right before we hopped on, I saw that Ethiopia made a deal with China to settle their trades in yuan. What did they say exactly? Ethiopia in talks with China on converting dollar loans to yuan loans. And so it seems like the U.S. Treasury, the Fed, are in a very precarious situation where they're walking a tightrope 200 yards above the earth, trying to make sure that they can manage any liquidity crisis that may be emerging. And then on top of that, they're getting attacked from another angle, which is one of the largest superpowers in the world, China, basically opening up a competing settlement network backed by gold, and trying to use that as a reserve sort of assets. And I think Luke said something that I've been thinking about since we recorded last Monday. It's been a week now. Posted the episode on Saturday, though, but it's like foreign governments now officially hold more gold in reserves than U.S. Treasuries. Like, is that a signal that the sort of U.S. dollar reserve system has been supplanted?
Yeah, I mean, going back to February, China held about 784 billion. Now, just in the past, 7 months or so, or I guess it's 5 months. I'm looking at July data. So just in 5 months from February to now, that's down to 730 billion. So a reduction of, 54 billion. That's significant. And then you couple it with what you mentioned about Shanghai and what China is doing with gold. I think it's interesting because it kind of is what the U.S. needs. Like, to go back to the discussion we had the first time, kind of on the silent depression and some of the kind of structural issues, it's actually, in my opinion, going to help that situation as countries move away from the U.S. Treasury and into something like gold, something neutral like gold. I think that it will actually improve a lot of the issues that we had talked about with a 4% of GDP current account deficit, and of course the resulting capital inflows that disproportionately benefit those that have capital, those that have financial assets, that are buoyed by about $1 trillion of forced, mandatory, structural capital inflows into financial markets in the U.S. I added up from the BEA, the current account data. I added up from, I think it was 2011 or 2012 up through 2024. If you look at foreign purchases of real estate, those get recorded under FDI, foreign direct investment. And then you add in the estimated portfolio investment into REITs and MBS, mortgage-backed securities. You add that all together, and going back to 2011, 2012, I can't remember exactly which year it was, foreigners have purchased about 700,000 single-family homes worth of real estate. That's significant. And these are price insensitive buyers. They are buying to balance that current account deficit. So the same thing is true, of course, with equities. We know foreigners, that's one of their favorite places to recycle dollars into. And of course, treasuries, that kept yields very low, artificially low. And so, yeah, a move away from that recycling of the $1 trillion that we send out to the rest of the world in the form of our current account deficit, that $1 trillion is being recycled into dollar-denominated assets less and less. And it's not happening, we're not talking about overnight changes of like 50%. This is around the margin. And it would take years, if not decades, for this to fully play out. But if those foreign countries start to, instead of buying equities or treasuries or U.S. real estate with those dollars, that $1 trillion we are running in our current account deficit every year, if instead of dollar-denominated assets like those, they start to buy gold, that'll bid up the price of gold in dollar terms. And so gold can, and this is something Lou Groman's been super out front on, going back like 2 years, maybe even more, that gold, as there's a shift away from the U.S. Treasury or other dollar-denominated assets into some neutral reserve asset that freely floats in all currencies like gold, what you could get is a revaluation of some of these currency crosses. Because again, China's not running $1 trillion current account deficit with anyone. They run a massive current account surplus. I think it's like 5% of GDP. So there is no country, right, on the other side from China going, well, yeah, we used to recycle these into, I don't know, yuan denominated bonds, government bonds, but now we're going to buy gold. So you don't have that the gold price in yuan terms, at least from foreigners, being bid up in yuan terms. There's no offsetting kind of bid in yuan terms. Now, domestically, of course, we know they buy gold, but just kind of generally speaking, this is one of those kind of subtle forces that over a decade or two would eventually lead to a higher gold price in dollar terms and a lower gold. Gold will still get bid up in yuan for sure, but to a lesser degree. And so then what you have, you cancel out the two denominators because they're constant, gold to gold, cancel out the denominator. You've basically just set a new exchange rate. And this is something Luke has been talking about for a long time now, the need for a revaluation specifically of the dollar yuan cross rate. There's, of course, other currency issues. The dollar structurally overvalued. In fact, on a purchasing power parity basis in 2024, the dollar with the Dixie at like 105 was more overvalued than it was 1984, 1985, when the Dixie was 163. And of course, the Plaza Accord was just about, a couple months later. We were even more overvalued on a purchasing power parity basis in 2024 than we were back then when the Dixie was 162 or 3. And of course, the Plaza Accord happened right after, and we know what happened to the dollar. So I still think that whether it's kind of a gradual revaluation, like you mentioned, kind of the adoption of gold, it's happening more rapidly than I think some of us thought it would. I expected it to happen around the margin, but kind of more gradually. The degree, the rapidity, the velocity with which it's happening is kind of surprising to me. But whether it happens gradually in the mechanism I just described, where you get a weaker, a devaluation of the dollar versus gold to a greater degree than devaluation of yuan gold, then that could take 10, 20 years, but eventually you get a new exchange rate where the dollar is weaker versus the yuan. And of course, China has made it pretty clear in various statements they've been making for 5, 6, 7 years, top CCP officials, that they are trying to, number one, internationalize the yuan, and number two, reorient their economy much more in a U.S. model toward domestic consumption rather than this subsidized overcapacity export dumping sort of approach that they've taken, where it's just gain market share at any cost. There's a recognition in China, just like there's a recognition here in the U.S., with the current administration at least, that our structure of debt-fueled overconsumption and insane twin deficits, that has kind of run its course and the pendulum has gone too far in that direction. Just on the other end, China has recognized that their model has gone too far. And they, you don't get public statements by top CCP officials like that unless it has the blessing of, over there you disappear if you say something that, over here we get to have leaks and all this kind of public comments about stuff. Over there, not so much. So the fact that they've been pretty vocal about that, I think there's a recognition that both of our economic models kind of went to their logical conclusion, and we've seen peak globalization, in my opinion. I think that's pretty clear. I don't think it's controversial anymore. And that there's likely to be a meeting in the middle, whether that happens by Mar-a-Lago Accord or the mechanism you mentioned, where it's kind of a gradual gold adoption in place of the U.S. Treasury. I think either of them have the same end effect, which is a weaker dollar, stronger yuan.
Yeah. And it's very interesting to try to think through which happens. I mean, I'm looking at the price of gold right now. It's approaching $4,350. So it's cooling off a little bit after the run that went on last week and the week before, but that could certainly accelerate again. I think that's one question on many people's minds. Like, is this a blow off top? Is gold about to correct? But I do think we are in uncharted territory in the sense that I think this bid seems very different than anything I've seen in my life. Not that there's been many material bids under gold outside of 2011 and 2012. Obviously last year has been very good, but it seems like somebody's buying hand over fist, or multiple people are buying hand over fist, sort of seeing the writing on the wall. And then you pair this with the sort of geopolitical saber rattling between U.S. and China over the last 2 weeks, specifically with rare earth metals. And are we just getting a sort of show between Trump and Xi, where they both recognize, hey, we need to get to the table, but there's some showmanship? Or is the showmanship actually public sort of exertion of, hey, who has the leverage at the end of the day? And after my conversation with Luke, he would say that China has all the leverage, particularly if you believe that we need to go into this hyper-industrialized reshoring sort of era of the United States.
I don't understand how anyone could argue that China's not the one with the leverage. I mean, we lost effectively a proxy war to a country with 1/12 of our GDP because we have so completely hollowed out our industrial base that we can't even make the shells and artillery and Patriot missiles needed to for our own military to defend our own people. We rely on China for 65% of active pharmaceutical ingredients. So the actual drug that goes into the medication, those APIs, about 65% come from China. You kind of go down the list, right? China has everything that is actually needed. What do we have? We have a bunch of derivatives traders. We got a bunch of meme coin traders. We got high frequency trading firms that build the best high frequency trading algorithms. We got the most deep and liquid treasury debt market in the world, sovereign debt market in the world. But you compare those two, China's got commodities. They've got the chips. They have the active pharmaceutical ingredients. They got the rare earths. You go down the list of what they have versus what we have. And I don't know, the deepest, most liquid capital market in the world doesn't seem very important when you're talking about, when you get down to it. Look, maybe in 1990 peace dividend sort of world, that matters and that has value. But in a world that is, like you mentioned, more polarized with higher tensions geopolitically, more multipolarity, I think that it matters much less how deep your sovereign debt market is, how liquid your sovereign debt market is, and matters much more who has the commodities. Now, we necessarily have energy, which that I think is one of the areas of leverage that we do have over China. They are so utterly reliant on imports, energy imports, much more so than we are. We have abundant oil, natural gas, and energy resources here in America. And I think that this administration accurately identified that as being one of the strong suits, one of our pros, one of our benefits here. But at the end of the day, I don't think that the most liquid capital market in the world is really that important, especially when you're talking about a world that looks a lot different than the world we might be used to in the kind of peace dividend era. But maybe I'm crazy. I don't know.
No, I mean, I've had Luke on, Balaji, had somebody who's been over in China advising Western companies how to do business in China for 30 years on the show. And that's one of the main pieces of feedback is like, these guys are just like pro-China. Like,
I'm not. Just to make it super clear, I am extremely patriotic. I love America more than anything. I could not be. I do not want to live in China. I would rather. I don't know. I'd probably rather die than live in China. Is not out of a pro-China. There's such this like knee-jerk reaction nowadays to when it came to the war in Eastern Europe. It's the same thing. And with China, I see that sometimes too. There's such this like effort to pigeonhole just because you make a criticism about your country. I think it was Mark Twain that said that there's no deeper patriotic duty than criticizing your own country. That's kind of how I look at it. It's not that I'm saying these things because I hate America or that I love China. Couldn't be further from the truth. It's more that, I want to see America return to the strength that we all know it has potential for.
Yeah, and the reason I bring it up is because I agree with you. I think there's people that are just denying objective reality. When you look at it, like you go through yes, we do have liquid capital markets and good high frequency traders and a great services economy at the end of the day. But if you do believe that we're moving into a more multipolar world, globalization has seen its peak and we're going towards a more deglobalized world, and you're trying to look at the objective facts, it's like, the leverage is going to be.
Yeah.
How many lawyers do we need? We need less. We need probably like 10% of the amount of lawyers that exist. Because that gets to a whole nother can of worms is like the problems they create by writing more laws and regulations and permitting requirements, whatever it may be. But I digress. When it comes to China, people saying you're on patriot, never bet against the United States. I completely agree with that. But I think before we even place chips on the table to make a bet, it's like, all right, let's acknowledge objective reality and try to figure out the best solution based off of that objective reality. You can't put your head in the sand and just say, don't worry about China. Nothing's going to happen. I think the last 2 weeks have proven that they do have leverage as it pertains to rare earths specifically. And that's one thing through these conversations that I've been trying to just sort of tease out is like, what is like, and ideally in my mind, it's like China and the United States, Trump, Xi, however you want to frame it, get to the table and get a deal done. And I think China just wants to be recognized as a legitimate economic power and political power on the planet. They don't want the U.S. meddling in things in Southeast Asia and observing objective reality. And with that in mind, saying, hey, we may need to make some concessions in terms of swallowing some pride and saying, hey, China, we agree. You guys are doing some pretty miraculous stuff, and let's try to work together and not get into some kinetic war, because in 2025, kinetic war or even economic war is not good. The leverage in the system is too high, and it's a tinderbox for a calamity. I want to see the route where we figure out how to work together and just increase the quality of life for all humans.
Yeah, same goes with Russia, in my opinion. My ideal world is global cooperation, not globalization, not this neoliberal approach that both parties had taken for decades, right? Not that, but peace. I think, hopefully most people, at least our age, are of that mindset. There is certainly a camp that does not wish for peace, it's always yearning for conflict with some new country every week. It's a new country, but I would like to see tensions with Russia and China decreased. But, I think that we have to be honest about the shortcomings that the U.S. economy, that U.S. society, again, it kind of goes back to our prior conversation, like all of those criticisms when I bring up deaths of despair and the suicide rate and all those various statistics, it's because I think the first step is admitting what the problem is. Most people don't even talk about that stuff. Although I will say that in the past, 6 months, 9 months, there's been a growing discourse, a growing conversation when it comes to the kind of silent depression stuff. Someone told me the other day, they're like, "What do you call it? It's not very silent anymore." And I said, well, when I started talking about it was, but I think that that's the first step, is recognizing the areas. Look, I think that the average American would, if they were polled, be able to tell you, especially average young American, would be able to tell you, yeah, I don't know what world you live in, right? If you have $5 million in your 401k, you got 2 or 3 homes that are up, 800%, and all the equity, all the wealth created there. Yeah, the boomers are doing great. Of course, they're not going to see any of these issues. So there's a large amount of generational gap there as well. But I think that the first step is and I think to some degree it's going to take some of the younger people starting to come into power politically. And you already kind of see that already on both sides, I would argue, to some degree. You're already seeing a bit more representation from the younger crowd, the millennials and to some degree the Zoomers. And I think that's important because there's a huge generational component to it too. Boomers seem to live, every time, I see one of these kind of head in the sand type speeches or comments or whatever, it's always a boomer that is living in 1960s America in their head, 1970s America. And it's not that way. I think that the picture would be a lot different if you spoke to especially younger people.
What's up, freaks? This rip is brought to you by our good friends at Silent. Silent creates everyday Faraday gear that protects your hardware. We're in Bitcoin. We have a lot of hardware that we need to secure. Your wallet emits signals that can leave you vulnerable. You want to pick up Silent's gear, put your hardware in that. I have a tap signer right here. I got the Silent card holder, replaced my wallet. I was using Ridge Wallet because it's secured against RFID signal jacking. Silent, the card holder, does the same thing. It's much sleeker, fits in my pocket much easier. I also have the Faraday phone sleeve, which you can put a hardware wallet in. We're actually using it for our keys at the house too. There's been a lot of robberies. They have essential Faraday slings, Faraday backpacks. It's a Bitcoin company. They're running on a Bitcoin standard. They have a Bitcoin treasury. They accept Bitcoin via Strike. So go to slnt.com/TFTC to get 15% off anything, or simply just use the code TFTC when shopping at slnt.com. Patented technology, special operations approved. It has free shipping as well, so go check it out. What's up, freaks? This rip is brought to you by our good friends at Unchained, and they are holding another live event that you should check out. Markets are choppy, layoffs are in the headlines, and rate cuts aren't fixing the core problem. That core problem is that the fiat retirement system is taking on water. On October 28th, Mark Moss and Unchained's Jeff Vandrew will explain why 401ks were built to serve the system, not you, and how fees and hidden risk create an illusion of wealth. You'll learn why Bitcoin's security and growth curve make it a powerful long-term savings asset, and how a Bitcoin IRA can let you roll over an old 401k with tax advantages intact. If you want a retirement plan that prioritizes sovereignty and purchasing power, this is the event. Register now at unchained.com/TFTC. Unchained.com/TFTC.
Yeah, with that in mind, obviously Trump surrounded himself with something like J.D. Vance, most importantly, as his vice president, millennial. He seems to get what's going on, at least domestically. I think he stood up against H-1B visas and really standing up for the American worker. Specifically, with that in mind, in terms of domestic policy to fix these problems, how would you grade Trump's performance so far?
Not as good as I was hoping. A little disappointed. Could have been a lot worse, I'll say that. But yeah, there's a lot of talk on a number of things that we haven't exactly seen follow through on. It's still early. The one thing I'll say, he's still got some time. I'm not going to, totally condemn the performance because we still have time. Like you mentioned, JD Vance has been pretty vocal on some pretty important issues like the H-1B. So, I'm cautiously optimistic, but unfortunately, I think that due to the fiscal dynamic and due to what's going on kind of economically, I think that we're going to get into a situation where, for example, that K-shaped economy probably actually gets worse. We know Trump wants negative real rates. We spoke about that in the prior conversation. That's not going to be good to fixing the K-shaped economy. Ironically, kind of go back to early April and Liberation Day chaos, stock market is plummeting. Who was on CNN and kind of CNBC and these various kind of, normie mainstream media outlets? It was a bunch of rich boomers that were upset, that were crying the hardest. That stock market decline. Now we know Trump capitulated mainly due to what was going on in the Treasury market, not necessarily the stock market, but we know he ended up capitulating. But, something like that, I was starting to get pretty optimistic. Okay, Besant, all of the talk about Main Street, it's their time to win. I was starting to get a little optimistic there in that first week of April because, you talk to the average 25-year-old about their stock portfolio, they got like, $200. They're living paycheck to paycheck. They're working 3 jobs. It's not exactly like they have millions of dollars in some stock portfolio. And if you look, like the top 10% of income earners own 92% of U.S. equities, right? So the bottom 80%, 90%, they weren't really affected. The average holding in a 401k is like $51,000. Which is not even, it's maybe a year worth of expenses. It's nothing. It's basically a rounding error. So yeah, I think that the bottom 90%, it was starting to look like, okay, they're willing to break things. They're willing to, because really what that would have been was a wealth redistribution, which is funny given the kind of like political implications of that. That's really what it was. You want to fix the K-shaped economy. Okay, you have to be able to tolerate a significant equity market decline. The problem is that, as again, Luke has been out front on this. I've done my own fact checking of it and found it to be correct, which is the government can't afford the stock market to decline in a meaningful, prolonged sort of way, or it so utterly hurts the wealth. The wealth effect starts going into reverse, and you start to negatively impact. You start to impair the capital gains tax revenue, blow out the deficit. As Luke says, the equity market de facto backs the U.S. Treasury market. So, they were never probably going to tolerate a significant equity market decline. But that was one of those areas where I was like, okay, maybe they are willing to break things. But then as soon as Treasury yields started to go vertical, 2 days later, it was capitulation. So I think that that's really the governing factor there is the Treasury market, not necessarily the equity market.
Yeah, and this is something I've been saying the last couple of months too. Is I think based off of the scenario or the reality that you just described, that the government sort of cannot afford this. So it looks like we're going the route of melt up equity markets, incredible debasement. Like individuals need to really take it upon themselves to protect themselves with assets like Bitcoin. And I've been pointing at Square's release of the Bitcoin functionality in their point of sale terminals. It's like, all right, you're not going to go fix this at the polling booth. You need to take advantage of this tool that Square has afforded you as a small business owner and begin saving some of your revenue, your cash flows in Bitcoin over time, because it seems clear to me that melt up is the way forward. And I think the gold price is screaming that as a leading indicator right now.
Yeah. And just to like make it really clear, even a bunch of TradFi people don't really get this. They look at gold as just a thing. Like they don't really actually understand what you're actually looking at, which you have to think of gold as a FX pair, right? So dollar yen, dollar euro, it's the same thing. It's dollar gold or gold dollar is how people normally look at it, which is how many dollars does it take to get 1 ounce of gold? The gold price denominated in dollars. But you take the inverse of that gold chart, which is just going vertical. You take the inverse of that, and that is the dollar denominated in gold terms. Gold has been money for thousands of years. That has its flaws for sure. All the properties, I think Bitcoin objectively does better, each of them. But that being said, gold has been money for hundreds, thousands of years. JP Morgan said, gold is money, everything else is just credit. I think there's some truth to that, even in today's day and age. So what is that really telling you? Well, what it's telling you, the way that the gold price gets bid up in dollars is that more people are willing to sell dollars to buy gold than are doing the opposite, which is selling gold to buy dollars. That's really what it's telling you. So what that reflects, now that you have, now that once you understand that way of looking at it, that lens to view it through, it's a pretty damning indictment of not only the dollar, but of course, kind of the institutions that back the dollar. And it's not just the dollar. I mean, gold is getting bid up in every currency, but historically, the dollar served as some sort of kind of safe haven asset, and we're not really seeing that too much. I do think that short to medium term, the dollar could show some strength here, just kind of generally speaking. But we've been seeing the yen, the euro, and the Swiss franc replacing the dollar in terms of when it comes to those risk-off sort of moments. What is getting bid? And this is true going all the way back. I noticed it in January, February. I wake up early here on the West Coast. I'd wake up and see equities would be down, yields would be up a little bit, and the dollar would be down. So bonds down, stocks down, dollar down. And I started looking at, okay, well, what's up? And it was gold, euro, yen, and Swiss franc. And that's kind of that theme is holding true, which, look, I don't think that you have to replace the dollar with the yen or the euro. I think that we're moving into a world that is much more, you mentioned multipolarity earlier. I think that's accurate. And I think that we should look at kind of global FX reserves and current, not one global reserve currency, but multiple diversification of these sovereign holdings, away from, 65%, I think it was at the peak, in terms of dollar denominated assets, mainly US Treasuries, and much more to, maybe we hold 10, 15% in US Treasuries and 10% in yen. And right, I think that sort of world with gold, and eventually I think Bitcoin, given enough time, that sort of world, right? Because people always push back so hard on like nothing can replace the dollar. And it's like, well, gold kind of is, number one. Number two, nothing has to be the global reserve currency. There can be multiple reserve currencies. You could imagine a world where dollar, euro, yen, and the yuan are all, 25% or call it 15%, and then maybe the rest gold. Something like that, which would take some time to get to. It's not going to happen overnight, but I think that that's much more where it's going. But what I think once people need to really kind of abstract out what the gold, how to think of what the move in gold is actually signifying. Because once you get it, it's red alert, what's going on in the gold market. And also it should be noted that the breakout, like gold has been breaking out. It's not just in this current administration. This started before. So.
Yeah, and that begs the question, like how underexposed are not only governments but institutions. I mean, how many of these hedge funds in the Caymans just trying to leech off this basis trade underexposed gold? I think there was a Bank of America report that came out a few weeks ago that something like 4% of hedge funds have any material exposure to gold. And is there like a whole class of institutional capital that's just completely missing this wave when their fiduciary responsibility is supposed to see it before it comes and benefit from it when it actually does manifest?
Yeah, I mean, I think institutions are, at least in the West, probably, I've seen similar reports. I think institutions in the West, firms in the West are underexposed, but also individuals. Like you had made the comment before about the debasement and kind of the run it hot sort of approach and like how badly that's going to crush. We were talking about the K-shaped economy getting worse. What I really worry about is the average American getting crushed by a run it hot sort of regime, by negative real rates. We know Trump thinks that since our discussion, we had mentioned negative real rates, how Trump thought that the Fed funds should be, I think back then it was like 1% or something, which would represent at the time a negative 200 basis point real rate. Well, now you have Stephen Myron, who Trump picked to be the chairman of the Council of Economic Advisors, and now on the Federal Reserve. He came out, this was like a month and a half, 2 months ago, and he said, I believe the neutral interest rate is 2%, which is notably below where we are now. And I thought, oh, well, that's interesting. But then like a week or two later, he comes out and says, no, the neutral interest rate is 0.5%, which is just insane to me when you have inflation at 3%, like solidly at 3%, and assets at all-time highs. You know, I think that they're trying to tell you which direction they want to go. And look, like it's not necessarily that they have a ton of optionality or choice in the matter. You know, this has kind of been starting to get baked in the cake, as Luke says, years ago. So it's not that they're choosing to do this, right? And I wouldn't. It's unfortunately just where we are, and just kind of what you have to do. Absent a productivity miracle, we're not going to cut spending, because you cut spending. I've done the math, and if you cut spending, if you bounce the budget, it would result in a GDP contraction worse than 2008 in the GFC. So you can't just bounce the budget, especially given what's going on kind of with the dollar's reserve status and what that might do to other assets. Of course, in the mid 90s to late 90s, we ran a surplus, and that caused all sorts of problems in, say, the equity market. And then that got kicked to the housing bubble, which, by the way, even the Economist on the Wikipedia article for 2008 and the causes of 2008, even the Economist, which is a fairly pro-globalism sort of outlet, even they admitted that the 5 or 6% trade deficit as a share of GDP in the early 2000s led to the 2008 GFC, the bubble, to the housing bubble. So even they're admitting that. So you have all these other issues with balancing the fiscal budget. But yeah, you would plunge the U.S. into a recession that would be catastrophic. It would be a margin call on the debt. So you can't do that. Like, what other option outside of a productivity miracle, which could also bring about mass unemployment, right, and all these other issues? Like, they don't really have a good option here. Unfortunately, run it hot, devalue the debt in real terms against scarce assets like gold and Bitcoin. And that's kind of the only option that they really have. Negative real rates to try to get the interest expense, which is one of the largest outlays. Try to get that under control, negative real rates, but that's going to be stimulatory. It's going to be inflationary. That'll make the K-shaped economy worse. That'll fuel the asset bubble even more. So yeah, it's unfortunate, because I don't really think that they have much of a good option outside of a run it hot. And they started telling us back in May or June, that they were, it was Scott Bessent, David Sachs, and Elon Musk, all within a week of each other, all came out back in, I think it was May, and said, yep, like, can't cut. That's not how we're going to get out of this. We got to grow our way out of the debt. They all mentioned that nominal growth has to be above the cost of the debt. And unfortunately, that's just kind of where we are. That's what we did after World War II. And, inflation was 18, 19% at the peak coming out of that.
Yeah, I know we touched on this last time we were on, but the productivity miracle, it's right around the corner. Have you seen everything going on with AI? All these data centers being built up. There's not enough supply of GPUs to feed the insatiable hunger for tokens in the world. Do you believe that there is any hope of an AI productivity miracle actually materializing?
I can say for myself that it has notably improved my productivity. I use it in a very particular kind of way, and it has significant limitations, right? But it's kind of constantly improving and tends to be getting better. Like, for example, you can tell it to write a Pine script code for TradingView, and it just spits out like, I could never do that. I'm not a coder. I have no idea. So things like that, and it's very quick too. It certainly boosted my productivity when it comes to, say, the YouTube video research or preparing charts. It certainly helped me. How much and how quickly the real productivity gains actually appear is a totally different story. So like, I've looked for good high quality data on that very issue and not really been able to find a ton of data, which is kind of surprising. I did put out that post, job openings to the S&P, kind of as a joke. It ended up going like giga viral. It was kind of a joke, but there's probably some amount of, I was hoping to spark some amount of conversation, because I do think that there is some amount, just from what it's doing personally for my productivity, I believe that there's got to be some amount of productivity gains coming from AI. Productivity for Q2 did come in significantly higher than expected by a lot. I think it came in at 3.3 and the expectation was like 2.6. So it did come in notably hot. Q3, I haven't seen yet, government shutdown. So yeah, I would imagine that there's some amount of productivity coming, but then you start creating other problems, right? Which is, okay, say it is going to be as transformative as some people say. Okay, well, now you might be talking about an unemployment rate of 20%. Well, how do you fund that? And so I think that's why, and I think Luke's correct on this, the productivity miracle option has to come at just the right pace, and it has to come at just the right intensity. Otherwise, it actually makes the situation worse. Because we know government's so inefficient. Like, for example, Medicare outlays as a share of tax receipts, when back in the early 70s, it was like 2%. Now it's like 24, 25, 26%. So we know how inefficient, and it's the same with Social Security as well. These government programs are incredibly inefficient allocators of capital, and the number of administrators and the bureaucracy and all of that. So it's not like a one-to-one, right? There's probably, for every dollar in unemployment benefits that someone actually makes, there's probably another 50 cents that's getting paid to government bureaucrats along the way, So yeah, I think that the problem is if the productivity miracle does come and it is transformative, it'll cause significant dislocations in the labor market. Those people have mortgages and car loans, and they go to the local Starbucks to buy coffee and whatever. And so AI being extremely deflationary, I've kind of understood this concept. I've been talking about it for a year and a half. I don't really know like how it ends up resolving, but immediately I thought, well, okay, if AI is as transformative and revolutionary as people say, okay, well, that's massively deflationary. And then I was like, okay, but the government debt to GDP is 125%. Now, private household debt, they have delevered after 2008. But on the sovereign side, we are so highly levered, 7% pro-cyclical deficit, 22% of tax revenue is going to interest, kind of go down the list. So, okay, if it's super deflationary, we're in this highly levered debt-based monetary system. Like, I kept telling people, guys, like, the story is how those two end up resolving. And the only conclusion that I've been able to come to, I keep pointing it out and never really knowing like how it ends up resolving. The only thing I can kind of rely on, I guess, or bet on, is that they will have to overcome the deflation from AI and robotics by printing even more money, right? So I think that's kind of where I've landed. I don't really see another option because it's incompatible with a highly levered debt-based system. And maybe someone can reach out and tell me another solution, but the only one I can think of is they print even more money to offset the deflation.
Yeah, I mean, that's what they've done already for the last 5 decades. I'm sure you saw, but the new head of product at X, Nikita Beer, or whatever his name is, was tweeting, basically making fun of Bitcoiners and gold bugs, saying, all the Bitcoiners and gold bugs are expecting hyperinflation when AI is going to be extremely deflationary. It's like, well, all tech is deflationary if applied the right way, or most tech. People were nitpicking because I quote tweeted with all tech, but we've seen incredible deflation driven by technology advancements over the last 5 decades, and the cost of living has gone up consistently. Quality of life for the bottom 90% has gone down consistently, despite incredible leaps and bounds and advancements in technology that have led to overall deflation in that sector. But it is not enough to combat the money printer. They need to print to keep it up. So despite all this tech deflation, until we pair that tech deflation with a reserve currency that is a sound money, Bitcoin is what I think it ultimately will be. You're not going to reap the benefits societally of that tech deflation.
Yeah, or until you've de-levered the sovereign balance sheet. If we could get debt to GDP back down to 50, 60, maybe even 70%, then it's a bit of a different story. The problem is the leverage is so high that a recession or a bout of deflation, sustained deflation, basically acts as a margin call on the debt. In the past 3 recessions, if you take an average, tax revenue in a recession falls by about 25%, spending goes up by about 15%. Oh, and GDP, the denominator in the deficit as a share of GDP, is falling. So you end up talking about like a $5 trillion deficit in just a normal recession. And so, yeah, it's a tough situation. They're trying to thread a needle here, and I don't know if it's going to work. Maybe there's some secret technology they have that they've known about that could help. But I mean, absent something like that, I think that it's just going to be even more inflation to offset the deflationary forces, unfortunately.
Yeah. Well, I guess to tie Bitcoin into this, obviously gold's been running. I think Bitcoin is a solution for individuals, institutions, governments alike to a certain extent to sort of protect yourself, as it seems obvious that we're going to have these extreme bouts of inflation moving forward as the government needs to inject liquidity into the system to make sure that it doesn't completely implode. But I think that's one question that's been on many people's minds, particularly Bitcoiners, over the last month is why do something? Why aren't you doing it? Gold's running to all-time highs. It's sucking the air out of the room, and Bitcoin, where it is in the halving cycle, if you believe in halving cycles, signals that the price should be running a lot hotter. People are very disappointed. How does Bitcoin play out into all this? What is your short, medium, long-term view on Bitcoin and where it fits into this bigger picture that we've been describing?
Yeah, short-term is hard. That short-term is really hard. Medium to long-term, though, I'm very bullish. I look at it. My conviction in Bitcoin is so significant that I like it. I like pullbacks. I like when it is not ripping higher, because when it's ripping higher, again, going to the prior conversation about gold, like my wages or my earnings are getting devalued when gold and Bitcoin are ripping higher. So I actually like when it's not ripping higher. I would like to accumulate more because, yeah, inevitably I know how this all ends up resolving. And look, it could take longer than we think. You know, it keeps feeling like, okay, well, we're nearing this event horizon or maybe even past it. Why isn't it feel like we are? Gold, I would say, indicates that we probably are. The way gold is, the price action on gold. I mean, it was up like 3% on Friday, or Thursday, I think it was. Had this like 3% monster day. Like, you don't see that in gold, especially routinely, day after day after day. It's every single day, it's like up 1% or more. So I think gold is kind of signaling that we're nearing an event horizon. I think that Bitcoin has too much of a NASDAQ high beta, aspect to it, unfortunately. So, there's been a bit of kind of volatility recently, short term at least, in SPY and QQQ. So I think that that's probably not helping with Bitcoin, although today both were up when we started to record. And then you had the cascading crypto liquidation thing that happened a week or two ago, and there's probably some amount of residual, deleveraging or going on there. But medium to long term, like, I'm grateful for this pullback. I wish it would pull back more. I want it back at 70K, 80K, because it's like, if you have enough conviction, you should be enjoying pullbacks. You should be wanting it to pull back because you're looking out into the future. And again, you have high conviction of that medium to long-term view. So that's kind of how I look at it. The longer that it is not going parabolic, the more time I have to accumulate, because inevitably, whether it takes a month or a year or 10 years, like, it's going much higher, in my opinion.
Yeah. And it is hilarious to people pointing at gold's performance this year, particularly, and saying, Bitcoin's not catching up. It's like, if you zoom out at the 5-year chart, Bitcoin's up like 900%, gold's up like 130%.
Yeah, since the ETF, it's up like, what, 250% since the ETF was announced. So
yeah,
that was just 2 years ago or so.
Yeah, I think it is a signal of the high velocity trash economy. People that are in Bitcoin, and I think they have visions of things they want to buy and things they want to do, and sometimes let those visions.
And I think that illustrates the problem, right? Which is, like, if you look at Bitcoin as just a number go up sort of phenomenon or asset, if you're just purely looking at it from that lens, and you have a low time preference, you have that kind of like fiat mindset of, I want Bitcoin price to go up so I can sell my Bitcoin for dollars. I think that is a different camp than a lot of Bitcoiners who don't view it that way and view it as the denominator of choice. I use gold and Bitcoin as denominators for a lot of things. And again, plot average hourly wage. Anyone with a trading view, plot average hourly wage divided by Bitcoin. Your wages are getting devalued when Bitcoin goes up. Like, once you start to realize that, I think that you start to kind of see things in a different lens, I guess.
Yeah. What was I going to say? Not only the devaluing, but I lost my thought there. When talking about the speed at which this happened. Oh, that's what I was going to ask. Like, then it's one thing we talk about a lot at 1031 is, like, there's an order of operations to Bitcoin's ultimate success. And I think, again, going back to the Square point of sale system, a lot of people are excited that you'll be able to pay in Bitcoin, and merchants will be able to accept Bitcoin, which is interesting. But the merchant adoption meme's been around since 2013 when Roger Ver was out, basically trying to convince everybody to accept Bitcoin. And if I'm being honest with myself, like, I feel like that part of the stack that they just released at Square will probably most likely be the least used out of all of it. But the tool to be able to sweep cash flows immediately into Bitcoin and hold that on the balance sheet is probably going to be the most used feature and the most valuable feature, not only for those individuals, but for Bitcoin more broadly. And I do think there has been a degree of complacency in the broader Bitcoin sphere of people just focus on number go up. It's like, well, we need to increase the utility of the tools around the Bitcoin stack to make it easier for people to adopt. And so I think people should be focused on that. Like, where can we begin to fit Bitcoin into these different nooks and crannies and get people exposure to it more easily?
I would say even outside, I would agree. But then even on the, like, number go up part, I had someone who sits on a board of a publicly traded company ask me about, this person knows I've been following Bitcoin for a while and I'm into it. Asked me about it a couple days ago, and I said, well, what makes you bring it up now? They're a boomer and older, and kind of was always very avoidant or dismissive of Bitcoin. I said, what made you? Why are you asking? And she said, well, our accountant asked us if we had any Bitcoin holdings. This is a publicly traded company, so I think that there's an element for, of course, we know it individually as a pretty amazing savings technology individually, but even as you gain adoption of it, just psychologically, once it becomes more of a valid, once people start looking at it more as a valid form of savings technology, which is the primary method I look at it as, I think even that is a step in the right direction for Bitcoin, because then those people adopt it. And then maybe they can start to play with a Lightning wallet or whatever, right? So I think the primary funnel for most people, whether it be corporations, whether it be sovereigns even, or whether it be individuals, is the savings technology. It preserves your purchasing power because in dollar terms, it goes up in price. But then that, once you're exposed to it, once you've used it, once you've bought some Bitcoin, once you've sent it to a wallet, maybe you have a cold card or hold it in self custody, and once you understand the concept of like holding your own keys, once you start to like kind of play with it and go down the rabbit hole, I think that it leads to all of the other benefits, all of the kind of more peripheral sort of benefits that whether it be like as a means of transaction and that sort of thing. So I think the primary funnel will continue to be the number go up component, but that's only because the denominator is melting, unfortunately.
Yeah, and then in terms of not the converse, but the other side of the coin, the number go up is distributed peer-to-peer cash that nobody can control. I think governments are doing their best to funnel people towards the point of recognition, like, oh, maybe this makes sense for this reason, particularly in the UK, where they're launching digital IDs and speech laws. And I think come for number go up, and then Trojan horse, peer-to-peer digital cash that can't be censored by despotic governments. They're doing the job. The governments are doing the job behind the scenes to make sure people understand that they need that as well when the time's right.
It's not a pretty looking landscape out there politically, not just in the UK. And, I worry sometimes about 3 years from now, what will the US look like? We might have bought a little bit of time. I mean, some people would argue that, some of what we're seeing even now is leaning in the kind of technocratic or, techno dystopia, right, with certain companies and stuff. So, you can make the arguments even happening now here in the US, but at the very least, if you reject that argument, at the very least, it could happen here in, say, 3 years. So right now it's the UK, but I think that could make its way over here, unfortunately, with the rise of populism. And look, if the average American, the average blue collar American that's been on the lower leg of the K, that's watched, the capital class just get obscenely rich and so on and so forth. If that lower leg of the K that elected President Trump, if they don't feel like he has adequately fought for Main Street, as Besson always says, it could get pretty crazy, I think. People dismiss a AOC presidency, but I think that they'd be wise to rethink that, because I think that populism is not just going to be on the right. We're seeing a rise in populism. I think if you look at like New York, I think we're seeing it across the board.
I think New York's going to be luckily, it looks like we're going to have a case study in left-leaning populism in New York. And hopefully they can blow, that's, what's the word I'm looking for? They can mess that city up to a certain extent in a quick enough amount of time that people are able to point at and say, look, this is what AOC wants to do to the country. Let's not go down this route. But
I mean, look, going back to 2016, this is not like a new phenomenon. I remember back in 2016 in the Rust Belt, they would go, CNN, MSNBC, they would go and interview just average people, just average blue collar, middle of the road, just average people. And they say, who are you voting for? Who is it between? And they would say, well, kind of, I like this Trump guy, but I also like Bernie. And it like just completely broke their head. These kind of, partisan type that live in Manhattan or live in Washington, D.C. like it just completely broke their head that you could be between Trump and Bernie. But I think that going back, that was a signpost. And that was back in 2016. So I think it's only going to kind of accelerate from here, unfortunately. Because populism, look, going back to what we were talking about, debasement and that whole conversation, populism, the last time the US had populism really was 1965 through 1982. In dollar terms, denominated in dollars, the S&P 500 basically went sideways. In gold terms, the S&P 500 lost 90% of its value. We didn't have Bitcoin back then, but in gold terms, the S&P 500 lost 90% of its value. Populism is not good for financial assets. It's not good if you care about inflation. And so, that'll eventually come into conflict, of course, with the bond market, which we kind of have an idea how they're going to resolve that conflict with QE or yield curve control or something. But populism is a period in time where you want to own scarce bearer assets. And I think that, Bitcoin is the best because gold can always be confiscated. They could kick down your door and, you have to physically hold it, or it's held in a brokerage account. So it's not really your gold. Number one, it's not real gold. Number two, it's not actually yours. So yeah, I think, memorize 12 or 24 words, makes it the best asset to own in a period of time of increasing geopolitical tension, a period of time of increasing political polarization, ideological polarization, even racial division here in America. And of course, the economic side of it as well. I think that it's pretty much the only thing when people ask me, they're like, you watch this stuff all the time. This is all you do all day. Like, what should I do? I got 10,000 or 20,000 or whatever. And like, I've thought about it a lot. And at least for myself, the only option I keep coming back to is like the only thing that I have high conviction in is Bitcoin and to some degree gold. Although the parabolic run in gold makes me wary of recommending that. I was buying some in 22 and 23, but after the run that gold's had, it's kind of hard to recommend gold. And then so the only thing that you're left with is Bitcoin, because we know cash had been good, right? Money market fund, you get 4.5%. That's cool. But like that is a melting ice cube more and more with what they're doing with the federal funds rate. So like that was kind of the last straightforward thing outside of Bitcoin. So now it's kind of like it's getting to a point where, for me at least, the only thing that makes sense is Bitcoin. I'm not going to buy the S&P 500 at a price to earnings of 3,000, whatever it is, price to sales at 3.3 times. I will say that's not to say the S&P or the NASDAQ stocks equities can't go up. I looked at the price to sales of the Lebanese stock market during their currency collapse. People were making such a big deal about the price to sales ratio of the S&P at 3.3 times. That is so historically overvalued. And so I looked in Lebanon and it reached 62 price to sales. So, it's not to say that the equities can't go up in dollar terms, but what people really need to start doing, and I've been trying to bang this drum, is start changing the denominator. Whether you like gold, whether you like Bitcoin, gold is good because it's been around a long time. So if you're a macro nerd like me trying to evaluate data, you have more price history. But use Bitcoin as a denominator. Denominate stocks in Bitcoin. Whatever you're thinking about investing in, housing, right? Denominate the average sales price in Bitcoin. It looks a lot different than in US dollars.
Yeah. I mean, just 2 points there, like to your point on populism not being good, going back to 65 to 82. To your point, if you price everything in Bitcoin going back to 2016 when populism really became as big of a thing as it is here in the United States today, like S&P is probably down 95%, 99%. Going back there in Bitcoin terms and gold, obviously, Luke and many others were sharing that chart a few weeks ago. If you price NDX, S&P, real estate prices and gold and Bitcoin, they're down significantly. So like this could be a conversation we're having where we're in the middle of the debasement of the populism, whatever it may be, and people will look back retrospectively 50 years from now and be like, oh yeah, they were in the middle of it as it was happening. And then to your point on gold too, like when China just discovered a mine with 83.5 billion.
Yeah, the world's largest gold mine.
Yeah, and so supply of gold is not nearly as inelastic as Bitcoin. Bitcoin's perfectly inelastic, no matter how much demand for Bitcoin there ever is at any given point in time. You're not going to be able to create more of it. And China just found the largest gold reserve in history.
That's a consequence of a higher gold price.
Yeah.
Right. Is you find more gold. It unlocks supply, whether it be through people willing to sell their gold to buy fiat currency or whether it be through new supply. So that's a consequence to the higher gold price. Like you mentioned with Bitcoin could go to $10 million per Bitcoin tomorrow. And there's no, now sellers could be encouraged, right? Long-term holders that go, okay, well, that I'll sell 10 million, but there is no new Bitcoin supply-wise that can come in. So that's one of the reasons it's so much better, I think.
No,
one of many reasons, but
fascinating times. Thank you for taking some time out of your early Monday morning to rip it. This is great. And I really value your consistency. As we were talking before we hit record, it's admirable how consistent you are with the analysis. And it's been Infranomics has been a great channel for me to check in once a day and just see what you're thinking, what you're looking at, and trying to get a better, well-rounded view of what's going on in the world of finance.
I appreciate that. Yeah. I just, again, my prime goal is to help kind of the average person that I know not very many people can watch all of my videos because I do release one every day, but hopefully, those that you might find interesting, take a look, because my only hope is to explain some of these very complicated macroeconomic concepts and phenomena to normal people that don't have the time to nerd out to the degree that I have, because you shouldn't have to. You shouldn't have to be so obsessively devoted to, I'm crazy. So you shouldn't have to be crazy to understand how your money works, how your economic system works, how the global trading system and global capital flow shouldn't require that much energy. So that's kind of the first, I think the first step is for the average American to understand the problem, because once you understand the problem, then it makes the solution, I think, pretty straightforward. So yeah, that's the prime goal. If that sounds interesting, you could go check it out.
Passionate's the word. I don't think it's crazy. I think you're extremely passionate about this.
I always liked puzzles. From when I was a kid, I was a nerd. I didn't play with the kids. I did puzzle books and stuff. And like when I kind of came to markets, it was like, well, this is basically the world's biggest puzzle with the most high stakes. So it's kind of how I look at it.
Fun puzzle to solve.
Yeah. For me, it is at least. Yeah.
Yeah. Well, hopefully we do this again. Let's catch up beginning of next year, maybe.
Yeah.
See how everything's playing out in the world of Bitcoin, gold, debasement, polarization, deglobalization, all the buzzwords. It's interesting time to be alive, and appreciate you joining us today.
Yeah. Thanks for having me on.
All right. Peace and love, freaks. Thank you for listening to this episode of TFTC. If you've made it this far, I imagine you got some value out of the episode. If so, please share it far and wide with your friends and family. We're looking to get the word out there. Also, wherever you're listening, whether that's YouTube, Apple, Spotify, make sure you like and subscribe to the show. And if you can leave a rating on the podcasting platforms, that goes a long way. Last but not least, if you want to get these episodes a day early and ad-free, make sure you download the Fountain podcasting app. You can go to fountain.fm to find that. $5 a month gets you every episode a day early, ad-free. Helps the show, gives you incredible value. So please consider subscribing via Fountain as well. Thank you for your time, and until next time. Okay.